BlackRock manages trillions of dollars, more than the GDP of most countries, more than the economic output of entire regions. But size isn't what makes it powerful, because in finance, size can disappear overnight. Markets crash, liquidity freezes, credit spreads widen, confidence evaporates. History has shown that even giants can fall. So the real question isn't how big BlackRock is, it's how it survives. What matters isn't how much money you manage, it's how well you understand risk. Because risk is invisible until it isn't. And while most firms try to predict markets, BlackRock built something different. Not a prediction machine, a system. A system designed not just to manage portfolios, but to map relationships between assets, to measure hidden exposures, to simulate shocks before they happen. And when markets tremble, when volatility spikes, when panic spreads across screens worldwide, that system is already calculating the fallout. Quietly, continuously. In real time, it's called Aladdin, and it quietly reshaped modern finance. To understand the system, you need to understand the structure. BlackRock is not a traditional bank. It doesn't take deposits, it doesn't issue mortgages, it doesn't lend directly to consumers. It doesn't operate like a hedge fund either. Instead, it manages money for others. Pension funds, insurance companies, governments, central banks, sovereign wealth funds, universities, endowments, institutions responsible for long-term stability. These aren't traders chasing quick gains. They manage retirement savings for millions of workers. They manage national reserves meant to stabilize economies. They manage insurance pools designed to pay claims decades from now. Their time horizon isn't weeks, it's decades. Which means one thing matters above all: risk. Interest rate risk, credit risk, duration risk, inflation risk, currency exposure, liquidity stress, counterparty exposure. When you manage trillions of dollars, a 1% miscalculation is not small, it's billions. A sudden rate hike can wipe out years of yield. A liquidity freeze can trap capital. A credit downgrade can ripple through portfolios. That's the environment BlackRock operates in. Highly interconnected, highly leveraged, highly sensitive. And that environment demanded something bigger than spreadsheets. Something scalable, something systemic. Aladdin stands for Asset Liability Debt Derivative Investment Network. But the name only hints at its scope. It isn't just software. It's an integrated risk management ecosystem, a centralized platform that connects data, analytics, trading, compliance, and reporting. Imagine interest rates suddenly rise by 1%, bond prices drop, long-duration assets lose value, debt servicing costs increase. Before panic spreads, Aladdin has already simulated the shock across portfolios, across asset classes, across currencies, across regions. It doesn't just look at one fund. It maps correlations between thousands of securities. It tracks stocks, government bonds, corporate credit, mortgage-backed securities, derivatives, ETFs, private market exposures. It measures how they interact. It stress tests portfolios under extreme scenarios, recessions, liquidity freezes, currency crises. It answers questions institutions constantly ask. What happens if inflation stays elevated? What if oil spikes? What if a major economy slows? But here's where it becomes powerful. Aladdin doesn't just analyze BlackRock's funds. Other institutions use it too. Banks, insurance firms, asset managers, pension funds. Meaning large parts of the financial system are being modeled through similar analytical infrastructure. That's not control, but it is structural relevance. In financial crises, governments don't need noise, they need clarity. They need someone who understands the plumbing of markets. During moments of instability, BlackRock has been consulted for its expertise in fixed income markets. Why? Because bond markets are the backbone of the financial system, and Aladdin specializes in understanding fixed income risk at scale. When you understand where risk sits, you understand where pressure builds. When you can simulate cascading effect, you become valuable during stress. Infrastructure doesn't shout. It sits beneath the system, quietly processing data, running simulations, mapping exposures, balancing risk. Over time, infrastructure becomes embedded, and embedded systems shape decisions, portfolio allocations, risk tolerances, asset rotations, capital flows, not by command but by design. That's a different kind of power. Not visible but structural. There's another dynamic at work. Over the past 2 decades, passive investing exploded. More capital flowed into index funds. BlackRock became one of the largest providers of ETFs in the world. As assets under management grew, so did data. More transactions, more portfolio compositions, more market signals, more data flows into systems like Aladdin. More data improves modeling precision. Better modeling improves risk forecasting. Stronger forecasting builds institutional trust. Trust attracts more mandates. More mandates increase scale. It becomes a feedback loop. In finance, compounding doesn't only apply to money. It applies to systems, to data, to infrastructure, to trust. And when systems compound, they become extremely difficult to replicate. Of course, concentration raises questions. When a small number of asset managers hold significant ownership stakes across thousands of public companies, some critics worry about reduced competition. Others question the influence of proxy voting. Some analysts ask whether centralized risk modeling could create systemic vulnerability. If many institutions rely on similar frameworks, do they react the same way during stress? Does shared infrastructure create stability or synchronized behavior? BlackRock argues it acts on behalf of clients. It represents shareholders. It implements policies based on mandates. It builds tools for transparency. The debate is nuanced because modern finance is nuanced. Ownership doesn't equal control. Modeling doesn't equal direction. Influence doesn't equal authority, but structure matters. And structure shapes outcomes over time. BlackRock's advantage isn't just capital, it's architecture. In a world defined by volatility, the institutions that understand interconnected risk, that model exposure in real time, that embed themselves in financial infrastructure, operate differently. They don't chase headlines, they build systems. And systems endure longer than strategies. In modern finance, power doesn't always look loud. It often looks technical, embedded, operational, and visible to most participants, but visible to those who know where to look. And in a system driven by capital flows, infrastructure is power. If you want to understand how global capital really moves, subscribe, because this system is only the beginning.